Assalamualaikum and salam Ramadan to all of you. My name is Nur Umaira, your moderator for today's forum, and I hope this morning you guys have the energy to listen to our forum. In today's session, we will discuss financial risk. But before that, I would like to introduce to all of you our wonderful and smart panel for today, Miss Rose Shuhada from Rasa Sayang Corporation as Risk Manager and Mr. Irfan as Risk Analysis. They will be talking and spreading the information about financial risk. As we know, financial risk refers to the uncertainty associated with the possibility of financial losses or adverse effect on organizations' financial position due to fluctuation in financial markets or economic condition. There are 4 common financial risks, including credit risk, currency risk, interest rate risk, and gearing risk. So our first panel for today, Miss Rose, how are you today?
Alhamdulillah, thank you for asking, Ms. Myra. I'm feeling great and honored to be here and ready to engage in some insightful discussion today.
Wonderful. Could you explain to us in detail the definition of credit risk and how can businesses mitigate the risk?
Certainly. Credit risk refers to the potential for financial losses caused by debtors who fail to fulfill their payment obligation. This can happen when another party doesn't meet the terms of contract. So a company's exposure to credit risk depends on various factors. This includes the volumes of credit sales, the organization's credit policy, the credit term offered, the quality of customer in terms of credit risk, as well as the effectiveness of credit venting assessment procedure and debt collection protocols. So in order to mitigate this risk, business can take several steps. Firstly, they can conduct thorough assessment of potential debtors or customer before extending credit. This helps in understanding their creditworthiness and reduce the likelihood of default. Additionally, businesses can mitigate credit risk by diversifying their customer base and not relying heavily on a single debtor. This spreads the risk across different parties, reducing the impact of potential defaults. Furthermore, businesses can establish clear communication channels with customers regarding payment terms and expectation. By maintaining open and transparent communication, companies can address any potential and mitigate the risk of late or non-payment. I think that's all for the credit risk.
Thank you, Ms. Rose, for your true explanation of credit risk and its implication for the businesses. Your strategies for mitigating these risks are practical and valuable. What about you, Mr. Irfan? How about the currency risk that we can relate it to the financial risk?
Thank you, Ms. Myra. Currency risk, also referred to as foreign exchange risk, is related to changes in the currency values. Specifically, this risk measures 2 approach, which are potential for gains or losses. And that depends on the situation that your business is currently having, paying or receiving the money. If your company is doing business internationally, then you are exposed to currency risk. And that is important to know since it can directly affect your business. So creating a currency risk scenarios is simple as you understand the basis exchange rates between different currencies. Say that your company, a US-based company, is having a business deal with a European company. For example, you are obliged to pay 1 million euros to settle your debt. At the time you acquire the inventory, the current exchange rate is 1 euros to 1.2 US dollar. Now say that at the time you were supposed to settle all your debt, suddenly the exchange rate shifted to a new rate, 1 euro to, let's say, 1.3 US dollar, meaning that the euro is becoming stronger. Since the currency exchange rate has now equal to $1.3, then you would spend more money in converting the fund. But if the euro is weakening, then it goes vice versa, meaning that you will spend less money in changing the fund. Currency risk is a thing that may not be inescapable when making foreign investment. but there are something that you can do that could help to mitigate any negative impact. So specifically, there are different hedging strategies that you can use to soften the blow of currency risk. First, it's important to understand what's happening with a particular country's currency that you are involving business with. So if a country is carrying high level of debt, for an example, then it can be a precursor to increasing inflation. As inflation rise, it means that the currency values is unstable and can decline. So one of the keys to hedging against currency is focusing on companies that are economically stable and are set to remain so. Other than that, company also may work through initiatives such as forward contracts or leading and lagging technique. That's all for me.
Thank you for your detailed explanation of currency risk and strategies for mitigating its impact. Understanding the fluctuation in currency values is crucial for the businesses engaged in international transactions. Do you agree, Ms. Rose, on Mr. Ifan's views? And how about the interest rate risk? Do you have example of what's happening in today's world that increases the risk of interest?
Thank you, Ms. Omaira, and thank you, Mr. Ifan, for bringing up the currency risk. And I agree with Mr. Ifan's perspective on currency risk, as it indeed poses significant challenges to business operating in global market. So regarding to interest rate risk, it's definitely a crucial consideration for businesses. Interest rate risk refers to the potential impact of interest rate changes on a company's financial well-being, affecting the value and liquidity of both fixed and floating rate exposure. This risk isn't just limited to bond prices, but also extend to stock prices, foreign exchange rates, and overall economic growth. So in today's world presents numerous factors that could lead to interest rate risk. For instance, uncertainty surrounding central bank policies, geopolitical tension, and macroeconomic indicators can all contribute to interest rate volatility. And there are a few ways to mitigate the risk, and one approach is through the use of interest hedging instruments such as interest rate and future contracts. These tools allow businesses to lock in favorable interest rate or establish predetermined rates, and thereby reducing the exposure to interest rate fluctuation. And another strategy involved is diversifying financing sources. By spreading borrowing across different types of loans and financing instruments, including both fixed and variable rates option, companies can minimize the impact of interest rate changes on their overall financial position. And lastly, I might say continuous monitoring and analysis of interest rate movement, which market trends and economic indicators are also essential. By staying informed about potential risks and opportunities, business can make proactive decisions to mitigate the impact of interest rate fluctuation. And that's it for the interest rate risk.
Indeed. What a strong view you have regarding interest rate risk. Interest rate risk is crucial too. It refers to the impact of interest rate changes on a company finances affecting bond and stock prices and foreign exchange rates. Let's move on to Mr. Ifan. What about gearing risk?
Thank you, Ms. Umaira. Before we jump into gearing risk, we must first understand what is gearing. Gearing is the amount of debt in proportion to the equity capital that a company use to fund their operation. It serves as a measure of the extent to which a company funds its operation using money borrowed from lenders versus money sources from shareholders. An appropriate level of gearing depends on the industry that a company operates in. So gearing risk is the risk of financial difficulty through taking on excessive commitment connected to debt. If investment returns are less than the gearing cost, then the borrower may be unable to service the loan. If so, selling some assets might be required to avoid default. There are some ways to manage the risk of gearing. One of it is to invest in a high quality investment invest for a long term, or they can also diversify the investment, meaning that they can spread the risk over a range of asset classes so that the poor performance asset will give limited effects towards the company. And that's all from me. Thank you.
Thank you, Mr. Ifan, for explaining gearing risk. It's crucial to recognize the balance between debt and equity that a company employs, as it directly influences its financial stability and growth prospect. Now we are heading towards the end. To conclude, the discussion has shed light on various types of financial risks businesses encounter in their operation. Each type of financial risk presents its challenges and consideration for businesses. Thank you to both our panel for today for spending time and sharing with us some valuable information regarding financial risk. See you again at the next forum. Assalamualaikum.
Waalaikumsalam. Thank you.
Waalaikumsalam. Thank you.